Ever found the perfect investment property? You know, the one you know is going to be a cash-flowing machine, only to have a bank just slam the door right in your face. They look at your tax returns, they see all your smart business write-offs, and they say, sorry, you just don't make enough on paper. It is so frustrating, right? And it feels like the system is rigged against entrepreneurs. But what if? What if there was a way to get a loan where your personal income didn't matter at all? This is the Brick by Brick channel, where we help beginners build wealth through real estate, one brick at a time. Today, we are unlocking the exact tool that experienced investors use to bypass the banks and scale their portfolios. I'm going to break down what this loan is, exactly what you need to qualify, and I'll give you a step-by-step action plan to get your very first deal funded.
I mean, this is the big one, isn't it? This is the question that holds so many aspiring investors back. But you know what? The answer doesn't have to be yes. Okay, let's dive right into this.
So, what is this big secret? Well, it's not some crazy, complex financial trick. It's actually a specific type of loan that's built just for investors. It's called a DSCR loan.
So here's the magic. In essence, you're not the one applying for the loan. The property is. Its only job is to prove that it can pay its own bills. So instead of putting your W-2s and pay stubs under a microscope, the lender is focused on one simple question. Does this property make enough money to cover its own mortgage?
And here's how they figure that out. It's a beautifully simple formula. Lenders take the gross monthly rent and they divide it by the total monthly payment. Now that payment includes your principal, interest, taxes, and insurance, what we investors just call PITI. That's it. It cuts right to the heart of what makes an investment work, cash flow. And this chart shows you exactly what they're looking for. See, a ratio of 1.0 means the property breaks even. Anything over 1.0 and you're cash flow positive. The property pays for itself and then some. But if it's below 1.0, that means you'd have to pay out of your own pocket every month. Now, lenders typically want to see a DSCR of at least 1.0, but the best terms, those are usually reserved for a ratio of 1.2 or even higher. All right, so if they aren't looking at your W-2s, what are they looking at? Let's get into your personal checklist and see what you actually need to have in order. Okay, check this out. What's so interesting here is the fundamental shift in focus. A traditional loan is all about you, the borrower. They put your whole financial life under a microscope. But with a DSCR loan, the property itself is the star of the show. Now, hold on. While your income isn't the main event, your credit history, yeah, that's still super important. Most lenders are going to look for a score of at least 640. And it's worth knowing that a higher score, say around 720, that's going to unlock much better interest rates and terms for you. It just shows the lender that you're a responsible person, even if the property's doing the heavy lifting. You're also going to need to have a bit more skin in the game. Unlike some loans for your primary home where you can get in with very little down, for a DSCR loan, you should expect to put down at least 20, maybe even 25%. This really shows the lender that you're a serious investor and you're committed to making this work.
Lenders also want to know you've got a backup plan, a safety net. You'll typically need to show them you have anywhere from 2 to 6 months worth of the property's full mortgage payment, that's the PITI, just sitting in a bank account. It gives them confidence that if you hit a brief vacancy, you can still cover the bills, no problem.
So once your personal finances check out, the focus shifts entirely, and I mean entirely, to the property. You should seriously think of this next part as the property's job interview. It needs to prove it's the right candidate for the job of paying its own mortgage. And this quote right here, it absolutely nails the lender's mindset. They aren't just giving you a loan, they're underwriting a small business. And this property, it's the entire operation. It has to be a self-sustaining enterprise. So you're probably wondering, how does a lender even know what the rental income is going to be? Well, they'll order a special kind of appraisal. The appraiser doesn't just figure out the property's value, they analyze comparable rentals in the area to project its fair market rent. This appraisal is absolutely key because it provides the income number for that DSCR calculation. It makes sure the deal works on paper before you ever close.
Okay, so you've got your ducks in a row, you've found a killer property that cash flows. So what's the actual process look like? How do you get from here to holding those keys in your hand?
And you know what's wild? This process is often way faster and more streamlined than traditional loan. Why? Well, it's pretty simple. There's so much less of your personal financial paperwork to dig through. The lender is focused on the property, and that simplifies the whole underwriting process big time.
Okay, I know this loan sounds like a total game changer, and for a lot of investors, it absolutely is. But it's not perfect. It's a specialized tool, and like any tool, you've got to understand the pros and the cons to use it wisely.
So, as you can see, the benefits are powerful.
No income verification, the ability to close in an LLC to protect your personal assets, and no limit on how many properties you can finance this way. The trade-off? It usually comes down to cost. The interest rates and fees can be a little higher than a conventional loan, and you'll probably have a prepayment penalty. But for serious investors, this trade-off is almost always worth it to scale their business and grab cash-flowing assets without all the usual red tape.
So what does all this really mean for you? It means that number on your W-2 doesn't have to be the ceiling on your ambition anymore. It means your side hustle, your freelance career, your growing small business, that's no longer a roadblock, it's a launching pad. This tool unlocks the door for entrepreneurs to build real wealth through real estate based on the merit of their deals, not the structure of their tax returns.
If you got value from this, do me a favor and hit the like and subscribe buttons for our weekly investor breakdowns. And keep building your real estate foundation brick by brick.